Hey everybody, this is Charlie Dobbins, and I want to welcome you to tonight's edition of the Multifamily Investing Academy's Masterclass Elite Group Coaching Call. And also, there are a lot of people from the Owners Forum on this call as well. I want to welcome you all. Tonight's topic is what is a multifamily key principle? I've been getting this quite a bit lately. A lot of people don't quite understand the concept. I want to kind of put it down in the nitty gritty. I want to put labels on it so that you all understand exactly what it means and what it entails. And if you don't qualify for a multifamily mortgage, don't fret. That's just another hoop you have to jump through, and aligning yourself with a qualified key principle is the solution to that problem. We do it for you here in the Owner Forum, and I want to explain to you how this works so that everybody is on board. Okay, as usual, I missed this last time on our last call, and I don't want to miss it again. As required by the Massachusetts Bar Counsel's Office, I'm a lawyer. I'm not your lawyer. Get a lawyer. Best money you ever spent. Okay, I'm going to introduce you one of my longest friends here in the multifamily business, and one of the key principles that I introduce a lot of my students to, a lot of my clients to, if they cannot qualify for a multifamily deal. Bob is the name of his company is U.S. Real Estate Ventures LLC. Bob is a New Hampshire native, as am I. Bob, are you on the line right now? Can I hear you?
I am, Charlie. Thanks for having me.
Thanks, Bob. Good to have you. Now, let me kind of give everybody a little bit of background. You and I met in my past life. I coached you with another one of those gurus. And at the time that you and I started working together, how many multifamily units did you own?
None.
None. Okay. And how many do you own now?
Actually, let me rephrase that. At probably a minus 200 because you talked me out of the first 200.
Okay. Those are the best deals I ever talked you out of, Bob, I'm sure. Now, how many do you have now?
A little over 1,250.
Okay, excellent. How long did it take you to do that?
Probably 5.5 years.
Okay, so slow and steady wins the race.
Oh yeah, definitely.
Good. All right. Now tell me, you and I obviously have, a lot of people have actually seen what was your first deal. Your first deal was at 36 unit in Charlotte. Is that correct?
That is correct.
All right. What was the last deal you got involved in?
It was a portfolio of houses, small multifamilies and mid-sized multifamilies that was a mess. That we took about 4 months to put together all of the due diligence. I think the stack of title insurance and title search was about 700 and some odd pages.
Wow. And how many units was that?
79.
70. Okay.
So we raised the money to buy it outright with no debt.
Wow.
And now we're clipping coupons.
Oh, good for you guys. Well, that's like the deal that we just did. We did 207 single-family homes where we took them over essentially as multifamily properties. We bought the property management company, and it was in dire straits when we took it over, and we just through I don't want to say like sleight of hand, et cetera, but we refinanced the property. We've got the occupancy up, and that property is now cash flowing $25,000 a month positive every month. So that is here we are talking about multifamily, but we're really just in the business. We're looking to buy cash flow, and that's how we do it.
Yeah, and what we did is we kept the multifamilies and sold off the single families
to
the point where we paid all of our investors back.
Excellent. Now, how long did it take you to sell those singles? Do you sell them as like one big block or one-offs, or what do you do?
All the above.
Okay. Yeah. We're looking at putting together packages ourselves for some investors down there in the Jackson, Tennessee area. So I know what you went through, Bob. Feeling it now.
I didn't go through it. Someone else did.
Yeah, of course not. You're like a key principal. all you ever do. All right, and for the record, Bob and I've been to Bob's house down there in Asheville, North Carolina. He's taken me fly fishing. That's his huge favorite pastime. It was Bob and I. Bob, do you remember the first time you and I met?
I'm trying to remember where.
Newport, Rhode Island.
That's right.
Yeah.
Yes, Irish pub.
Yep, exactly. And then you invited me down. I was going to speak at the Asheville RIA, and you said I could stay at your house, but I first had to get approval from your wife. And so when you guys were up in Boston the next time, I had to go out and like be interviewed by Deb to make sure that I qualified and was worthy of staying in the house. And I guess I passed. I passed. So.
Well, you were borderline leaving the nation, so it was questionable.
Exactly. So that was a great time, and I'm looking forward to doing it again. So, all right, now let's get into this whole concept of a key principal. You know, what qualifies you, Bob, to be a key principal? What is it that banks, and this kind of ties into the next question, what do lenders want to see in a key principal? So let's talk about that for a second. Now, typically what happens is if a new investor is looking to get into a deal, and the bank is going to start to do the underwriting process, and in the past, if you could fog a mirror, you could get a multifamily loan. And then the whole market crashed, and a lot of these first-time investors lost all their deals, and so the banks started getting a little bit more critical in who they were giving the loans to, and they wanted to make sure that the person had qualifications, that they knew what they were doing. And a lot of the new investors, with that qualification in there, they're ruled out. So how do you overcome that obstacle and get qualified for a mortgage if you have no experience? And the bank has allowed you to come around get around that problem by coming up with a key principal solution. In other words, having somebody involved in the deal that has the resume, that has the gravitas, that enables them to qualify as a key principal. And typically, and Bob, tell me what you've seen in this area. From an underwriting standpoint, what they like to see is somebody with, obviously experience, preferably in the same geographical area, and then also a balance sheet that is equal to the amount of the property that they are buying, and also someone with liquidity that equal to I think it's 1 year's worth of mortgage payments. And by doing that, they you can aggregate the other members' key principals in the group and combine all of their cash together to meet that requirement. Bob, what have you seen when you've gone to be the key principal?
Well, that's pretty much true, Charlie. I just call it, are you bankable?
Yeah, exactly.
They're looking for what your experience is. They're looking for what is your liquidity, what is your overall net worth, like you said. I'd like to also add in to the mix is having a great, really strong property management team that has experience as well. And it's like when I go to a lender, I want to have the best resume for the lender and go in and say, here's what I'm doing, here's my schedule of properties owned, here's my personal financial statement, and here's the property management company, and here's their resume and what they can do and what they've done.
And by doing that, you've checked off so many boxes that the bank is always looking to check. You've just solved so many hoop jumping problems just by walking in there with that resume. Now
That's better to be proactive.
And you also own the property management company as well. You and your partner do.
My partner does. I'm not that foolish. I like to have a staff of me. He has a staff of over 85.
Does he really? Good for him. Now that is something that has really helped you guys out tremendously, hasn't it?
Oh, absolutely.
I mean, this concept of, putting it on remote control, letting some third-party property management company run your business for you, have you tried that? How'd that work out for you?
I tried that when I had 3 single-family houses, and it was disastrous.
Yeah, yeah. I mean, that is I teach in so many of my classes that it's just a recipe for disaster. The whole formula just doesn't make any sense. And so many people like yourself, Bob, 5 years ago you had nothing, and now you got 1,200 or 1,400 properties and units, and you need to have your own property management company to make this thing work.
Oh, absolutely. I mean, there's so many things that happen that I find out about after the fact, because my property management company that I use is, we partner on deals. We buy properties independently of each other. But one thing that is consistent is that he manages all my properties, regardless if we're partners on the deal or not.
Yeah, that's excellent. It's the only way to do it. Now, if anybody has any questions for Bob, just type them into the question block, and I will get to them and ask them as we go through the process. Now, this is interesting, and I came across this question today, which kind of made me think that maybe we should talk about this whole topic, for all the students. And that is, how does a key principal become part of the deal? Now, so let me just kind of paint the picture, give you a little backstory, and then you fill in the blanks, Bob. Let's say, for instance, that a student, an owner form student gets out there, they make an offer, it gets accepted, they start the due diligence process, the deal looks great, they start to move into the financing process, and they realize, hey, in order for me to qualify for this deal, I need to get a key principal. Now, up to that point, they've been working the numbers. They know what the property looks like. They've negotiated the final deal with the seller. They've got the sales price set, and now they know how much money they need to raise, what type of cash and cash return that property is going to generate, and they now can start to figure out how much of the deal can they keep for themselves, and how much of the deal do they have to sell off to cash investors to raise money and make the deal happen. Now, at this point, when they've figured out how much they get to keep, they now have to solve this other problem of getting past the bank, because the bank says they're not bankable. And so now they've got to turn to a guy like you, Bob, and they need to say, hey, Bob, I want to get you into my deal. I need you into my deal. How can we make this happen? Now, Bob, I'm asking this question more from a legal structural standpoint than from a value cost standpoint. So how is it that I can bring you into the deal? What's it going to take, Bob, for me to get you into this deal and make this deal and make you part of my team? What is it that you're looking for?
Well, first off, this is a loaded question, Charlie.
I know.
First off, you got to be vetted by Charlie.
Well, that's true. Yeah, I mean, because what Bob's saying is, Bob is one of my, bank of key principals, and I only bring my owner forum members to Bob. Now, this audio may be going out to everyone on my list. It may be going out, that's something you can download on LinkedIn. But the fact is, if you want to get to Bob and have Bob say yes, you got to be in my owner forum class so that I can go through the deal and make sure that it's a good deal before we even turn it over to Bob. So assuming that these people are members of my owner forum, and that I like this deal, and I come and introduce you to the buyer, Bob, what types of discussions do you have with the buyer at that very early stage?
Well, the first question that is sometimes is the last question is this a recourse or a non-recourse loan that they're trying to acquire?
Okay.
I will only work non-recourse loans. You want to go over what that's
yeah, because that's part of the thing when we sit down and we start looking at the deal. If it's a small deal, below $1 million, typically the bank is going to want it to be a recourse loan, meaning if you lose the property, the bank can come after you personally for any deficiencies. The type of loan that Bob will only get involved in is called a non-recourse loan, which means that if the property goes south and there's a deficiency, they can't come after any of the key principals or the members personally. And so Bob's saying, and I know this for a fact, don't even bother calling Bob if this is not a non-recourse deal.
Pretty short and sweet on that one.
Yeah, yeah. Now, what about as far as the control of the property? I mean, you're putting your name on the dotted line, and these people that are partnering with you have never done this type of thing before. So you're kind of taking on a little bit of risk that they know what they're doing. What do you do in the form of protecting yourself or getting control of the deal if you need to, or anything in that regard?
Well, the first thing I do is I re-underwrite. Is that a word?
Yeah,
re-underwrite?
absolutely.
Re-underwrite all of their numbers to make sure they're what I think it should be. And if it's a good deal and gets thumbs up, then I take the next step and try to get to know the person that I'm talking with. This is a business, and it's a business of relationships. Real estate just happens to be the product. So from that point, my personal favorite is repositioning. That where there's hair on the deal, where you can either reposition the tenant or reposition the property physically, and see what the upside is.
But what about the structure? Obviously we do most of these deals in a limited liability company. So you're coming in as a member, and you're part of the. Are you always part of the buyers class of membership, or sometimes are you just one? You would fall under the cash investors category of members, where you don't have any voting really control over the property. You're just kind of moot when it comes to not moot, but mute when it comes to having a say in the deal.
I want to say in the deal, but I'm not going to be the deal maker breaker, but I want my vote counted.
Okay. All right. All right. So let's talk a little bit about the $1 million question. And this is before I do, I've got a couple.
Let me also add to that, Charlie.
Okay.
That also depends upon the person that I'm dealing with. You have one student that's probably maybe on the line that we're doing a deal in Virginia or in Richmond, and she knows what she's doing. So
she happens to be on the call. She happens to be, Bob. She happens to be on the call right now. So be careful what you say about her. Yeah.
I know. Can I say names?
No, let's not say names.
All right. Well, she's a great lady.
Okay.
And she knows what she's doing. So I have a little more hands off than someone else that is just getting into it, and this is their first deal in real estate of any aspect.
And by the way, she says, "Aw, thank you, Bob."
Yeah, right.
Yeah. Okay. So, but let's talk for a moment. You're in a couple of deals of mine, deals with clients of mine, as the key principal, and like you said, every deal is unique. But why don't you kind of give us an idea as to what you've negotiated with some of these investors to get you in as a key principal? In other words, how much does it cost to work with you as a key principal?
It's priceless.
It's oh, go on, because I'm not
That was a tough one.
Yeah, I know. I'm going to let that one go.
It depends on the deal. The deal in Richmond. There's three phases of getting paid. There's acquisition, there's cash flow, and there's profit on the back end.
The equity. Equity growth.
Equity, correct. Depending upon whether they need the cash flow or not to make it work, to do the repositioning, I may go in with no percentage of the acquisition fee, because I'm not really doing a whole lot other than adding my name to the bottom line, to the key principal line, but sharing a percentage of the cash flow and sharing a percentage of the equity on the sale. Other deals that I've done is a percentage of the acquisition fee, no percent of the cash flow because it was needed to run the property and do the improvements, and then a percentage of the equity on the back end. So
Okay.
every deal is going to be a little bit different, and I try to make sure that it's a win-win scenario. That's an overused term, but still pretty true.
Yeah, but if we're looking, let's say for instance that you know, the 100 slices of pie, and you know, they sell off 60 in order to get the cash in the door, and they're left with 40 that they own and operate. The buyer of the property, my client, the owner forum member, and then they come to you, and you know they own 40% of the deal. If you're looking to get some of that equity, you know, either in the back end or as part of the cash flow, what have you. I mean, what are we talking? You know, I know no deal is the same, but are we talking half of that is what it's going to cost to get you on board? 10% of that number, you know, or 25% of what they own? Like, any way you can give us some ballparks on what types of deals you've negotiated already?
Ballpark, I'd say 20-25%.
Okay, all right, that's fair.
Of the managers, not the overall.
Right, on what the guy owns. So of that 40 slices of pie left, you're looking to get 25% of that 40%.
That'd be 10 slices.
There you go. You got it. Now, I've got this one question here that I'm going to ask, and then we're going to come back to the how we structure these deals. Phil asked the question: how is your property management company able to properly manage properties that are in different towns without increasing the overhead too much? And I'm going to add, you know, because my property management company obviously does the same thing. But why don't you go ahead and answer this, Bob, and I'll follow up right behind you.
Well, our focus is on a 6-hour driving radius of western North Carolina. So that's Louisville, Lexington, Kentucky, Nashville, East, Upper Alabama, Georgia, Carolinas, parts of Virginia. So we're in the thought process that if something goes to hell in a handbasket, we can get in a car and not in an airplane and get there in half a day. Now, that's just our rule of thumb.
And what we've done is we've only bought properties that are large enough that we can put our own staff on the property. You know, if we're looking at a property,
that goes without saying.
Yeah.
That's given.
Yeah, and I mean, if we're looking at a property, a 40 unit in Michigan, it's just not going to work for us. We would have to use third-party management, and because of that, we're probably less inclined to do the deal. You know, all of our properties are over 125 units, where we can keep a staff on site there. That staff they are our employees, so they report to us, and we have a system for keeping in touch with them, for monitoring what goes on, for looking at the numbers, and also we have our accounting department right here in our office that just handles multifamily accounting. So we have got all the financial and the computer system already in place in order to run these things. So we've built the infrastructure already. So that's how we're able to do it, Phil, from you know, from a distance and not have to worry about it. It doesn't impact the overhead at all. Actually, we save over hiring a third-party property management company. So hopefully that answers.
I keep saying we with the property management company. I don't have a thing to do with it. My partner owns it 100%.
Yeah, and he does a great job. I've seen his numbers, and he's got an accountant himself right on staff. That's the key. Is you got to keep track of the numbers. If you can't keep track of the numbers, you're in trouble. So, all right, Bob. So let me see here. We're talking about the affiliates. You look at maybe 25% of what the buyer owns. You're talking about the acquisition fee. You might get a piece of that pie. You know, and you know, you're looking for maybe 25% of the equity sometimes, depending upon what the deal allows. And with the equity also comes the cash flow, or you can carve the cash flow out separately from the equity and structure that entire deal differently. Now, for those of you that are listening to this call and you think that 25% of what you are getting in the deal is very rich, well, just let me tell you that 10 years ago, if you needed a key principal to qualify and the banks weren't all that worried about key principals, you could bring a guy like Bob on for 5%. You know, that's it. You pay him 5%, and you know, he signs on the dotted line and goes his merry way. Now, as one of my underwriting brokers told me, key principles are the new black. And that is the thing. Before it was the down payment that was the barrier to entry. Now key principles are the barrier to entry, and therefore the value of key principles has gone up, and the cost for key principles has gone up as well. So when you can find somebody that can get you past that hurdle and get you on the other side of the deal, hey, 25% of what you're taking is not a bad deal. It's actually something that you might want to, that you're going to have to do. And the whole idea is you want to get to the stage where Bob is right now, where you're becoming the key principal for other people. That's the thing. Wouldn't you agree, Bobby?
Absolutely, but don't get there too fast.
Yeah, take your time, build it right, do it the right way. Now, how do you work with a key principal like Bob? You got to get to me. You got to go through the owner forum. I introduce you to Bob. If Bob is the right person for the deal, I have other key principals that I can recommend and connect you with, all depending upon your particular deal and your structure. So the whole idea behind the owner forum is to get you to the other side of the closing table so that you can own this baby. And we want to do it the right way. And by doing that, we've got to just remove all the hoops from all the stuff that the seller's broker, the seller, the bank, what they all throw up in your way, in your road. We're here to remove them for you, and Bob is one of the best solutions to it. So listen, we're running out of time. We have plenty of time, but we're running out of questions. It's really all I wanted to talk about with Bob on the key principal side. If anybody has any questions, I'm going to give you the old countdown clock and see if yeah. As a matter of fact, as soon as I did it, I just got a bunch of them. Yeah. First question, does a deal need to be a certain size or does Bob work with smaller units? The deal does have to be a certain size for Bob, primarily because of the financing. And the financing is dictated by recourse and non-recourse. If it's a smaller deal and you can get recourse, and you can get non-recourse loan, yeah, Bob might be a good solution for the problem. But the chances are very good that if you're looking at a smaller deal, the recourse loans are the only way to go, and if that's the case, Bob will not be interested in doing the deal. And also, Bob, what about geographical restrictions with you? Are you looking for just deals in a certain area?
No, as far as a sponsor, key principal, somewhere in the U.S., especially if they got great fly fishing.
Yeah. Oh, brother. Yeah, so that, Karen, hopefully that answers your question. Now, okay, now Manish is asking the question, out of the deals coming from me, how many do you see? And what do you typically participate in? Why do you reject deals? Okay, let's break down this question step by step here. Out of the deals coming from me, how many does Bob get to see? Geez.
Not enough.
Yeah, Bob would love to see all of my deals, I can tell you that. But, I don't think all of them fit Bob's. And
they don't. I mean, every key principal has different criteria, and that's why you have to go through Charlie to vet, which makes it good for you as well as good for us.
Yeah, I don't typically see. I don't typically send Bob everything. I don't want to. Key principles in this business are gold, and I like to maintain very good relationships with my clients who are key principals, so that I can connect them with my owners forum members so that they can get deals done. And I don't want to burn out my key principals. So Bob's not going to see every deal that comes across my desk. Now, and which ones do you typically participate in, and which deals do you reject, Bob? Now, let me tell you, Bob has rejected some deals that for clients of mine. I mean, I know down in the Atlanta area, Bob, you rejected some.
Well, we started off on the process of working together, and after I went and walked the property and started looking at the numbers and what the management company was all about, the on-site management company, it was a deal that I backed out of just because what Charlie and I were told was not what the deal was.
Yeah. Yeah.
So I try to walk all the properties. When I'm buying a property on my own or with my partner, we have a clause in our purchase and sale agreement that in our LOI, excuse me, that between the LOI and the purchase and sale agreement, we have the option of walking every unit.
Oh, that's good.
I feel that if we can get all the nitty-gritty out of the way before you go to the purchase and sale agreement and get it done without as much lawyering as possible. Sorry, Charlie.
Could not agree with you more. I have no issue with that. So, all right, Manish, hopefully that answered your question. Now, Bob, what do you think about North Charlotte?
North Charlotte?
Yeah.
I think it's great.
Okay. All right. So one of my clients, one of my owner forum member students has a deal in North Charlotte. So I'm not going to mention your name, student, but absolutely, let's get that deal in. She just got a lead on a deal in North Charlotte, and let's bring it in. Let's analyze it, and if it looks good, we'll make an offer on it, get it under contract, and then get it in front of Bob. And
is it by the university?
If that student could answer that question for me, is it near the university? We'll wait and see what she has to say in just a moment. But I don't know if she knows. She's not from the Charlotte area, so either way, Bob, we'll get it in. She's going to check, but we're running out of time. But I'll get an answer for you. So if you're on the owner forum, you got a deal in that particular area, you want Bob to take a look at it, give you his thoughts. I know that a couple of deals that we worked on early on, we'd actually looked out in the like in the south of 20. When you hear that term, you're talking about Atlanta. And Bob, I can tell you right now that I kind of learned this the hard way. Bob is not interested in property south of 20 in Atlanta. So can't get financing. Wow, interesting. All right. So any other areas that you just wouldn't touch?
Memphis.
I got to tell you, there's something about Memphis. What is going on with that city? I see so many deals from Memphis and they just never get done. Let me see here. What's concerned a good deal as far as return on investment, and does Bob come up with down payment? No, Bob does not come up with the down payment. He's a key principal, totally different. You are always responsible for raising the private money. I think Bob has helped out by introducing some of his people in the past for particular deals, but that is not what you're coming to Bob for. You're coming to Bob to help you get the financing. It's your responsibility to get the down payment. And as far as the return on investment or the cash-on-cash return, it really depends upon the deal. If for these people that think they're going to get a 15% cash-on-cash return on a Class A property, you're never going to find that. Good luck to you. So you really have to look at each deal individually and determine where is this, what's our exit strategy on this property? What type of cash-on-cash return can we expect? What type of growth? Why are we buying this property? So each property has its own story, the best thing to do is to sell it to Bob. I mean, you can't, you really, people that own multifamily property, I hate to say this, but we kind of get a little jaded, and we've heard it all before. And the last thing we want to do is listen to a broker tell us what it costs to run a property when they've never run their own property. We like to look at each property separately and determine exactly what we can do with each one and work our magic and make that property a cash flow king, or whether we're just going to turn around and walk away from it. So, Bob, the answer to your question is it near the university? The answer is Garner, North Carolina.
Garner?
Garner. That's all I got.
No, it's not near the university, but it's a good area.
Okay, good. All right, so yes, student, let's get that property in the door and work it up and see if it looks good, and then we'll send it on over. So, all right, Bob. Hey, I appreciate your time, and it's always good talking with you. And if you know, I'm going to get this webinar out on the rolls tomorrow, so everybody can listen to it again. And also, I think I'm going to blast it out to my list because everybody is always asking me about key principles. So, Bob, thanks so much for your time, and I hope you have a good night.
Anything I can do to help, just let me know.
All right, I appreciate it. Hey, thanks, everybody, and we'll talk to you again in 2 weeks. Talk to you soon. Have a great night, everybody.
Take care, Charlie.
See you, Bob.